Hey, quick reminder, I'm going to be streaming the Federal Reserve meeting on the Meet Kevin live channel, link down below. Let's get into the... Hey everyone, Meet Kevin here. Okay, obviously, look, this sucks. The market is not doing what we saw in March, where the market started rallying before the Fed meeting and then rallied for 2 weeks thereafter. So far, we're kind of getting a sell-off into the day, with the NASDAQ down almost 1.5% at the time of this recording. It's about $4 under that 0% fib line, which means we're breaking pretty critical levels that we had around the start of war on February 24th, March 8th, March 14th, right before the Fed meeting. It's crazy. And every bit of financial information that we're getting is just pure bearishness. Let me give you just a little bit of a summary of some of the madness going on. First of all, we've got lower retail flows than usual, $73 billion over a 3-month period compared to $77 billion, which we usually had. So we're kind of seeing a little bit of this decline. Some folks are saying that money is now being taken from the stock market and just parked into like money market funds because people are just tired of losing money in the stock market, because like it's fine to buy the dip for a bit, you know, like that should be the saying, buy the dip for a bit. And then it's like at some point it's just like, wait a minute, we've been playing this game since December. It's been December, January, February, March, April. It's been 5 months of crap. We've had like 2 weeks of positive, and it's been 5 months of crap. And we're on number 6 right now. We're literally on the 6th month of crap in the stock market. And so the average retail portfolio right now is down 23%. That is not like down 23% from the peak. No, like negative 23%. That's the average retail portfolio. And I know some people are like, oh, I'm all in commodities, I'm fine. Great, congratulations. Cool. Yeah, there are gonna be some people that made money. But the vast majority of people are having a rough time, and it's kind of becoming one of those things where, like, how could you lose less, right? You've also got wealthier and older generations that are like, I have to go back to work if we keep losing my wealth, so I'm going to sell and just, like, sit on the sidelines. And, you know, these are the times where it's like, wait a minute, maybe, because the macro environment is just so freaky right now, and everybody's so worried about the Federal Reserve, maybe we're actually potentially approaching a bottom, because everybody's expecting Jerome Powell to be a hawk today. In fact, even me, like I made a video, watch this before the Fed meeting, and I talked about all the reasons why I think Jerome Powell's likely going to be hawkish today. But by being hawkish, he's actually already pre-pricing in so much fear into the markets. I mean, we've got our 3% treasuries. It's starting to finally turn the real estate market. We're not sure if we're going to see a flood of sellers or not. We're seeing consumers still spend and travel like crazy, which is great. But, I mean, let's look at some of the information we got about the market. Bloomberg is telling us that maybe there is a chance that we'll get a tactical bounce in tech, healthcare, home builders, and emerging markets. Why? Because right now, we are pricing in the potential worst case scenario for the Federal Reserve. They're suggesting that the markets are pricing in a 50 basis point hike in May, again in June, and again in July. Like just 3 Fed meetings of 50 BPs in a row. And that might actually set us up for a reversal if we end up getting a little bit more of a dovish Fed. If it's like, okay, we're starting to see some of the overheating going away. Okay, we're starting to see inflation cap out. Used vehicle index still coming down. Commodities slowly trickling down. Look at lumber prices. They're well off their peak. I mean, in fact, let's just do it together really quick. If we just type into Google LBS price lumber from the NASDAQ, we'll get a little quote here. Here you go. Look at the 1 year on lumber. Let's get Kevin back here. There we go. So you've come off these crazy, insane highs that we had last year. We're not as low as where we were right before the whole Delta disaster, and certainly right before the war disaster. But yeah. I mean, those levels we were at LBS somewhere around $500 to $600, which if we look at the grand scheme of things, like lumber's still expensive, right? But we've also come off some of these highs. This is actually very similar to what inflation expectations look like. We've brought those inflation expectations down. Very, very exciting. So, I mean, hopefully, but that's all we have right now is hope that we peaked with inflation in March. but that's the only hope we have for a potential bailout. And maybe we get some dovishness that Jay Powell says something to the effect of, hey, like, it actually looks like inflation did peak in March. Maybe that would give us some hope and optimism today. But here's another thing that we've got. We've got bearish sentiment right now and buying of downside protection at the highest level since March of 2020. This means even retail investors are hedging with puts more than they have ever before since March of 2020. In other words, people are like, okay, yeah, no, we have to like continue to hedge here. While at the same time, smart money is actually taking an increased beta in this market, which means they're going long and they're taking more risk. See, if you have a beta of 1 and the S&P moves $100, you're expected to see your portfolio move $100, right? If you have a beta of 2, then for every $100 move in the S&P 500, you would expect a $200 move in your S&P 500 or your beta weight of 2 portfolio relative to the S&P 500. So twice the return, right? If you had a return of say $300, well, that would mean you had an alpha of 100. You had a beta risk of 2, which was twice the S&P 500, but you had a return of $300, which means you had $100 of alpha in there. This is why we call, there's the website called Seeking Alpha, right? Like people want alpha, which is returns above your risk-weighted portfolio. So what we're learning right now is that smart money is actually going long and they're going with higher beta, which means if they thought the downside was more, they're going to be losing more money going towards the downside faster if you're increasing your beta. Because like if the S&P moves down $100, you'll lose $200 with a beta weight of 2, right? However, if they're going long and they're increasing the beta, that's a sign that smart money is like, technically this could be a sign that we are actually in the direction of the bottom. Now, it's so hard to call the bottom because it's been such a frustrating market, right? It's been so difficult. We run off of these lows and then we return right to them, and now we've broken through some of them. But look at some of these others. I mean, we touched on these briefly the other day, but look at this. Net number of stocks declining, not yet at extreme levels, but I mean, I have to say, it looks pretty extreme to me. I mean, that I disregard the title here for a moment. Let me just hide myself for a moment. Look at this, folks, right here. See like these little green dots right here? This means the number of stocks declining versus like what the S&P 500 is doing, right? You can see like all of these super lows right here really corresponded to lows in the stock market. And so look at this. We're getting this sell-off here, and we're pretty dang low in terms of these sell-off figures here, right? And so a lot of folks are looking at this suggesting, hey, like, the things are lining up to say that we're pretty dang near a potential bottom. Anytime the stock market goes down, we also see excess liquidity at lows, which kind of makes sense. And so we're getting a little bit of that lining up, though not so perfect. Same thing here, long versus short volatility. Even though the title says does not show complacency, I think it's an easier way to say here that markets are really showing that every time you get indices go down, right? These downs right here that are in red, you end up getting the blue line, your volatility ratio, at these pretty dang low levels. And so that's what we're seeing right here. The same thing with sentiment, very much near bottom right now. The same thing with net number of stocks making new lows, 52-week lows. This one, we haven't seen that kind of like extreme decline yet though, which potentially is a signal like, oh, is there more pain to come? Yeah, I mean, it's possible. Nobody wants to hear that. It's absolutely possible. And we know 2022 is going to suck. But I'll tell you, everything we're reading right now is talking about how consumer demand is outpacing concerns about inflation, that small businesses are actually getting squeezed out of their ability to hire folks. We saw that in the ADP report this morning. The ADP report this morning was a disaster for small business. I mean, if you look at it right here on screen now, you see that like in the service providing sector, it's the very small businesses that are losing most of the jobs because they can't compete anymore with the large companies who are able to offer more benefits and more attractive wages. So we'll see. We'll see. And then obviously we had a miss on ISM this morning, which is we disappointed on expectations here, which is not good because this is a potential, evidence of a slowdown in economic activity. And Jerome Powell is going to get asked about that today. It's like, look, there are signs that you have tightened enough there are signs that the economy is somewhat starting to slow, even though the consumer is still spending like crazy. We just had a negative GDP print. And yeah, some of that had to do with inventory restocking in the trade def. But like, we can't expect all levels of the economy to keep booming while at the same time you guys are going crazy with your rate hikes, which they should have done earlier. But the level of hawkishness we're getting right now might actually, if they stay hawkish, lead to a policy mistake. And so I actually think the market right now isn't pricing in the fear of the Fed raising 50 basis points. It's the fear that's being priced in right now that Jerome Powell is going to come out as hawkish, and they're going to make a mistake. They're going to go, we're going to keep hiking, we're going to be data dependent, but we're going to hike. You know, he has that attitude today. The market's going to say that's it. Like, we're destined for a recession. I mean, Jamie Dimon over at JP Morgan has now increased their odds of a recession from 20% to like 35%. So they do expect that if we have a recession, it'll be mild, but still, you are seeing the market right now not pricing in rate hikes, returning to normal. We should have done that already, okay? We're seeing now fear that the Fed is going to make a mistake. And what we're seeing market-wide is that sentiment, pretty dang bearish, which could end up being a buying opportunity. And I know it hurts in the short term, because it sucks to buy when everything's red and it keeps going red. But that's how things feel right now. And the charts and what we're seeing in terms of the data, reiterating that. Fingers crossed, let's see what happens. Fed meeting coming up soon. Remember, I will be streaming that Fed meeting on the Meet Kevin live channel, so make sure to check out that channel. Link down.